Hello to everyone, wherever you're joining us from today. That looks like that's all working as we want it to. My name's Phil Brown. I'm one of the partners here at Xact. I am joined by not one but two of our client directors in our advisory team. Doug Adams, who is client director, but also our resident technical wizard. And when it comes to all things job costing platforms and technology, and these days leading the charge for the firm on our AI endeavours, both for ourselves but also for our clients. So, Doug, welcome. Thank you for joining us today.
Thank you, Phil. Thank you for the intro.
And Dan, who is our partner in the advisory team. Dan, great to have you on board again and to have another crack at this WIP topic. Thank you, Dan.
For another session. Thanks very much. We'll crack the nut today.
Yes, indeed. Little bit of housekeeping at the beginning here. So we're going to go through the framing. So I think part of understanding WIP is really just trying to understand it, the concept behind WIP. I think that will help people really understand then how the accounting or the math side of things plays out. So we're going to start to do a bit of scaffolding here and help people understand what the concept of WIP is. Then we're going to get into more into the weeds in terms of how the WIP number is calculated through, both at a job level but also across the business. So you can see your net WIP position across the business. Hopefully by the end of this session, you're going to understand how WIP works and you're going to understand how to pull a WIP figure together. And so we're going to take you through that today. Some logistics in terms of how the session's going to work. We're not using the Q&A function in Zoom. We're using the chat function, which, as we can see, is working nicely. I would say our preference is that if you have a question, maybe choose the everyone option so that you can share that question out into the room. It's fine if it's a sensitive one and you just want to ask us on the quiet. But we often find that if you're wanting to ask a question, no doubt someone else will. And it might be a good inspiration for them to ask a similar question as well. So please put it in the chat for everyone to see. We will be sending out the video from today. So please don't ask that in the chat unless you join us later on. But yes, we will be sending the video out after today. We will also be sending out a WIP tool, a calculator that we share with clients, with anyone really. It's a good little calculator. So we'll be sharing that out after today. There will be a few polls as we go throughout to keep things interactive, including one right at the end where we'll ask if you want to follow up with us about anything that you are interested in talking to us about. So hang on to the end for that one. And then finally, there's a survey. So, we love doing these sessions and we're always interested in making them better. So please give us some pointers on that as you exit the webinar today. Danny, next slide, if you wouldn't mind. Just a little bit about us. If you're joining us for the first time, we have four main pillars of the Xact business. The core and the foundational elements are tax and compliance. So this is all about minimizing the amount of tax you have to pay at the end of the year because of all the hard work that you've done. You don't want to hand over any more than you need to. And that space is changing quite a lot at the moment. So we do a lot of work in that space, particularly with businesses, builders, trades and the like who are already in the industry, but they're wanting to do sort of higher risk activity like run their own property development activity. So we help people structure those activities so that their assets are protected, but also so they can have the best possible tax position. Our bookkeeping service is an outsourced industry specialist bookkeeping service. So these guys understand how all the platforms fit together, understand the most efficient workflows in terms of having good, accurate, timely data in the business and keeping everything up to date so that you can do things like job costing and the like very effectively. And then finally, the advisory services we provide. So where Dan and Doug live is in our advisory team. So we offer financial control. So this is like having your own outsourced financial controller in the business to do all of the things like WIP calculations, close out end of month, journal adjustments, all those sorts of things, so that you have a really great end of month reporting pack, and someone like Dan and Doug to sit with you to go through that once a month to understand where the business is heading. And finally, ScaleX, which is having a growth partner. So someone who can help you scale the business, either the top line or get a better quality of earnings out of the business that you're doing already. So improve your margin and your profit position. So that's us. Next slide. Thanks, Danny. So a quick poll just to see where people are at on the WIP journey. I'll just fire this one off here. It's that one. Here it is. I'll launch our poll on WIP. We're very interested to see with the audience today what your current approach to WIP is. So I calculate it myself. My internal accountant or accounting team are calculating it for me. My bookkeeper does it. My tax accountant does it. I've got an outsourced advisor. Nobody's doing it. I think that's quite commonplace still. And then the other major question there, how often are you calculating your WIP figure? Is it once a year because of, your tax accountant's doing it, etc., or because maybe if you're in Queensland, you need it for your QBCC reporting? And then finally, hand on heart, honestly, how accurate do you think your WIP figure is? It's one of those figures that we are going to try and get almost perfectly right, because it's such a critical one in terms of being able to see our profit position. But tell us how you're traveling in terms of the accuracy of your WIP figure. Okay, I think we've had enough time to answer that, most people. So I'll just quickly show this. So we've got most people are calculating it themselves. It's good to see that a decent 41% are doing it monthly already. So that's really, really good. I think in previous years when we've run this, most people were sort of really either never doing it or they're doing it once a year. Out of 10, we're trending towards 7 or 8 out of 10. So hopefully today it's going to be more about refining your WIP calculation process, having a better way of going about it rather than, starting from scratch. But I know there are people like that here today as well. So hopefully everyone will get something out of today. Okay, Dan, we might move on now to the next slide, which I think is you. So Dan, I'll hand it over to you, and we're going to just start talking through a very basic definition of what WIP is. So Dan, if you could take it away, please.
Yeah, thanks, Phil, Doug, obviously for joining us. So everyone on the call today, thanks for carving out a bit of time and obviously spending a bit of time on the business as well. Some really nice numbers from the poll before, so I just wanted just to celebrate that. I mean, back when I jumped on board a few years ago, like the numbers were fairly dismal, if I'm not going to call it out, but I'm loving the education and the awareness and just the overall shift in the averages to being more attentive and I guess in people understanding their businesses as well. So just shout out there. The second piece, guys, please load up questions in the chat as well. There's some pretty serious talent on the call, obviously excluding myself. So between Phil and Doug, I'm sure they can answer some of the curly stuff. But yeah, please make the most of the time. And it's a safe space. Like, we want a community-based feel here. So chuck in some questions, be confident, and away we go. So what I'll probably start with first is I'll probably just explain what WIP is. And I love doing a lot of lensing before we get into the calculations, because if we understand why we're doing it, it does give a bit of substance as to why we're spending the time on it, why we, I guess, interested in bookkeeping and getting data right, because it will really shine the spotlight on the business and tell you whether you're okay or not. But if you're okay, high fives and hugs, let's go grab a beer. Or if we're not, well, what's the call to action to correct, fix, recalibrate, right size, whatever it is. So I'll spend a bit of time on this first. So what is WIP? So we'll start with positive WIP and negative WIP. And don't think positive is all happy and negative is negative. Positive WIP literally means if you're working on a project currently and say you're, I don't know, 30 or 40% of the way through the project and you've got the slab down and frame up and all the rest of it, but let's just say the bank's playing games or the client's playing games and you haven't been able to push out an invoice to them yet, but you've clearly spent a bucket load of money or you're about to spend a bucket load of money because you've got lots of invoices coming in, but you haven't pushed very many claims out, it's highly likely that your cash is low, but you will be carrying what's called positive WIP. In which case, don't freak out when you look, well, obviously caveats around this, don't freak out when you look at your cash at bank balance. You spend a truckload on site, you're clearly pushing the project through, but you haven't got the claims out, so you have what's called positive WIP, and I'll talk about that very shortly. Negative WIP, which is obviously the exact inverse of that. So obviously we aren't touching on contracts or anything like that today. I'm just talking conceptually. But let's say, for example, you manage to front load contracts, or say you get like a large procurement deposit if you're doing a multi-res site or something. So you might get a truckload of cash in, like large procurement deposit, whatever it is, but you haven't done very much activity on site. So you'll be looking at your cash at bank, your profit and loss, and going, hell yeah, I've made all this money. That's where I, unfortunately, or Doug, unfortunately, jumps over the top and goes, that's not right. A huge chunk of that cash or a huge chunk of that account receivable is not yours. Do not touch it. Do not spend it. Because you might have completed 5 or 10% of the progress on site and you might have invoiced 40% of the project, but there's no way you're up. I guess that's sort of 35% gap. So we come in and say that big chunk is not yours. So that's negative WIP. I love negative WIP because if you can leverage clients, banks' money, whatever it happens to be, obviously inside contract terms and regulations, etc., it means you can leverage clients' cash instead of your own equity or overdrafts or whatever it happens to be. So negative WIP, we love.
And so just the simplest definition is positive WIP. I've done the work, but I haven't invoiced it yet. Negative WIP. I've invoiced it, but I haven't done the work. That at its most first principle kind of granular level, that's what WIP is. So now we're going to walk through how this plays out from with a visual example. So Dan, just if you want to step us through that.
So this is a live example now. And again, I love pulling out my crayons and getting a little bit visual with this sort of stuff. So in this instance here, and please ask questions as we go, Bill and Doug will pull me up. But let's just say you have a project here that's worth $500,000. Ignore GST and all the rest of it. Like, let's just go really basic bones here. So you're doing a renovation or a bloody big deck or something, or a project home. And let's say the total contract value is $500,000 that you'll charge the client. Now, when we build up the quote, we say, well, the total project costs of $400,000. So obviously the difference between $400,000 and $500,000 will ideally be your margin. But inside the total project costs will be direct labor, direct materials, obviously all your trades. Hopefully you got your prelims in there as well. It's not just site prelims, but obviously some recovery for project managers or contract admin or whatever it happens to be. And this is sort of, I guess, where you start. So this can scale up to whether you're doing, I don't know, a $30 million contract or, a $250,000 renter or a $60K bathroom. It's exactly the same process. So we know we're charging the client and we know what it's going to cost to build. And we're assuming here that everyone knows how to quote and price work. Now, as the project gets underway, and the discipline behind WIP is I love to see people calculating it monthly. And that's just what big business does. Every big business I've been a part of, they get to the end of the month, close the books and do this sort of WIP process. So let's just say we come around to the 31st of July or 30th of June and we go, well, we have incurred costs of $100,000 on site. So just be really careful with this one. This is either, as in we have received an invoice from on site and we've entered into Xero or MyUp or whatever your accounting software is. It doesn't mean you've necessarily paid it. So it means that work's been done on site or you've paid a deposit or you're about to pay a deposit and the invoice is in the system. That's what that 100K is. So when you look at the total project costs overall, you can pretty simply go, well, 100K divided by 400,000, that's about a 25% completion rate. So you can go, yep, I'm 25% of the way through the project as far as the cost base goes, not necessarily schedule or throughput. Now, inside the same month, because this is an end of month close, so let's just say 30th of June, let's say we pushed out a couple of invoices. It might have been for the slab and deposit, and let's just say they equal $100,000 overall. So before we do WIP, you'll jump in a Xero and go, hey, am I making money on this project? And you'll run a profit and loss and go, well, revenue's 100K, costs are 100K, I've made no money. That's where someone like me or Doug or, even Phil would jump in and say, well, rubbish, because if you're generating throughput on site and there's no bleeds, well, you're clearly making money, clearly making margin, ideally, assuming we're on track and on schedule, on budget, etc. So what we do is we then come over the top and go, well, if we are 25% of the way through the project, we're actually we are actually entitled to 25% of the revenue and 25% of the margin. So what happens here is that we do a calculation. We go, well, what is 25% of the revenue incurred? Well, we're actually carrying positive WIP because you haven't been able to bill out as much as the cost that we have incurred. So what I mean by that is we have pushed out 25% of the costs, 25% of the activity on site, but we've only invoiced out 20% of the income. And if you're on site swinging the hammer on the nail gun, pushing trays through, you will be generating margin throughout the project as well. So we say that this 25K WIP entry here is positive WIP. So now when you run your P&L, you should be able to see that you're generating $25,000 in profit, which is where we want to land. That's positive WIP, and it can run the other way too.
There's just a quick question in there, Dan, about, this is a regular one we get. Yep. And it goes to what is the definition of COGS or direct costs? What are the costs that I can allocate to the project? And this one comes up regularly where you have a director of the business who's spending part of their time running the business, looking after sort of overheads and those sorts of business-wide activities, but then they're also on site for some reason or another. And so, yes, you can, if you've got a good system to do this, so if you're doing good time and attendance, timesheets and the like, then you can allocate part of their wages into the project as well. It's important to be able to capture time across the business because the labour cost in your business is going to be one of the most significant components. So being able to really properly track that and allocate it in where you need to is the way to go.
And it's just really important when you're doing that, if you're allocating those costs to that job, if you haven't allowed for your time in that quote, that's actually going to be counted as overruns, which we'll get to later, and it will actually erode your margin. Whereas if you know you're going to be on site and your time is going to be on that job, you need to cost yourself into that job at quote stage.
Just to round that out as well, and really great advice. Anything that's generally pre-contract, which could be either the design part of D&C or it could be estimating. Anything that's pre-contract is generally classed as an overhead, but ideally if you're in the design construction space, you are charging for the design work. And then I guess the second piece, Sandra, for everyone on the call, anyone that sort of thinks, touches, is on the job, whether you're swinging the hammer, whether you're managing by extension, or if you're the owner, you're wearing 84 hats, just make sure the one hat when you are on site directing traffic, directing people, that you do build that into your quote. So whether the director's wages, 10% or 50% or 80%, depending on where you are on your journey with your business, do make sure you build that in, absolutely. Otherwise, it's dead time. You're not valuing yourself at all in the job, which is crazy. Just have the confidence to build that stuff in, but don't go overboard, please. So, why is WIP important? The construction game, projects are lumpy. I mean, unless you're sort of lucky enough to do cost plus and you can invoice on the last day of the month, or say, for example, you're doing on-site scheduling and you got a really nice QA on site and you submit a claim and they go, yep, that's 100% right. Generally, WIP, you can probably get away with like a back of the envelope calculation, but it's extremely rare. Otherwise, you'll go, hey, I'm 30% of the way completed on site. You'll submit a claim for 30% of the revenue. The QS will go, no, you're going to get 15. And then you're going to look at your P&L and go, look, I'm making losses. What I'm trying to allude to here is that the construction game is lumpy. There's lumpy cash, lumpy trades, lumpy this. And if your P&L is bouncing around like a yo-yo and you're trying to figure out whether you're actually okay, especially if you've got multiple jobs, it can be incredibly difficult to decipher that. So it's important because WIP pulls revenue and costs into the one period, and you should be able to see month on month how you're performing overall. So we want to get away from lumpy P&Ls and I guess that anxiety bubble going up and down, and we really want to understand our numbers. Usually when I bump into a lot of owners as well, and Doug will be in the same boat, and even Phil, if people get frustrated with WIP or they do WIP and it doesn't make sense, or they calculate WIP and they say their margins are 50%, I find people get frustrated with it. They go to their cash and bank and go, oh, I've got a lot of cash. Stuff must be all right. And then you get smashed with your BAS bill or into a recently super or a large credit run. You go, oh my God, I've had a huge bite out of my cash. And you ride that emotional roller coaster. What I wanted to say out of this is I just can't express how dangerous it is using cash as a scoreboard, especially if you're running, say, a negative WIP business. And I'll talk about that a little bit later, but let's say you're running negative WIP, you have a huge amount of client cash that comes in, but you spend it all or buy a RAM or something, and you have this sort of cost catch up. it will absolutely give you a bite in the ass, pardon the French, towards the end of the project, middle of the project. So if you micromeasure profit to within an inch of its life, I'm talking about gross profit, not net profit. Overheads are 2/5 of not much in most businesses. Manage that to within an inch of its life across most projects. Cash will catch up, pending any client claims or disputes or, I don't know, volcanoes, etc. And then, as I mentioned before, WIP really brings the two together. So I've reconciled what your profit is to how much that cash in bank is actually yours, which is what we want to know at the end of the day, right? You could have 500 sitting in there, but 450 that could be accounted for through accounts payable, GST, whatever it happens to be. So I can't express how important WIP is. It is a commercial entry, absolutely, first and foremost. And then for stuff like tax compliance, that's a secondary piece in my book. But obviously, I'm a little bit biased. So why is WIP important? As I mentioned before, obviously knowing your numbers, especially when you have business owners or major stakeholders on here, is critical. I mean, there's several numbers you should know off the top of your head at any given point, especially when it comes to your business, but we've talked about that in other webinars. So banks want to know, so particularly if you want to, I guess, fund your next development, buy another car, say you're running a WIP asset business, so you're spending lots of money before you get money in, and you go, hey, I want to take the edge off that and get an overdraft or a funding facility or debtors finance, whatever it is. If you're giving the banks a P&L that doesn't have WIP and it's bounced around like a yo-yo, I can promise you they won't give you cash, especially if you need it as well, because they're going to look at the up and down, and go, oh my God, that's not predictable, that's not boring. You haven't got your finger on the pulse. We don't want to borrow that. So WIP isn't just for internal stakeholders, but obviously for external stakeholders as well. So banks want to see predictability. They want to see that you know your numbers, know your profit.
I think that kicks in a fair bit too, Dan, for those who are wanting to borrow for their own developments and put forward a statement of accounts where there's some rigor involved. Banks aren't going to lend on a whim, and your rates and the sort of terms that you're on are going to improve as you are demonstrating not just your track record in builds, but also the quality of your financial reporting as well. So those third parties are really going to run the ruler over that WIP figure and not just see it as a hit and hope figure, but see that there is some really strong fundamentals that are underpinning that number.
Yeah, completely. I mean, banks love predictability. They love boring lending. If they're seeing something that's bouncing around, they won't have a bar of it. Then you have to go to second tiers or third tiers, and the interest rates are through the roof there, and it's no fun for anyone, to be honest. Obviously, if you're a multi-partner business as well, so obviously, Phil and I are in business and a few of the other partners here, we want to know, each of us know our numbers, know our stuff, so it's no different. Obviously, to yourselves, you're lucky enough to be in business with someone, or say you have other shareholders, they want to know stuff's okay, their money's protected, their assets are protected, we're not going to tip over in 4 or 5 months' time, so that's really important. And then the final piece, so if you are doing your WIP reporting monthly, you shouldn't have to wait until, particularly in Queensland in December, when you do the WIP calculation 6 months ago, whether you're going to pass QBCC, MFR. If you're doing it monthly and it's predictable, you should know exactly where you're going to land even before you have to do your annual reporting, no matter what state you're in. So regulators obviously love it. So what I'm trying to say here is obviously lean into the process, understand your numbers, don't do the clench and hope and go, geez, I hope the regulator keeps off my back. That's the theory.
And it often is, in QBCC and the other states where WIP is taken into account and where those balance sheet metrics are in play, it often is the critical number that is the difference between being able to, get the compliance over the line or not, as long as it's being calculated properly and we've got the foundations in the bookkeeping data to be able to, properly run those numbers.
It's funny, we ran a webinar probably about a year ago, and I'll just sort of share a story, particularly on this. And I had a catch up with a client now, obviously. And he was like, oh yeah, look, I'm calculating my own WIP and I'm pretty confident in the data, et cetera, et cetera, et cetera. But when I looked at Xero, I'm like, how are you making 50% GP 1 month and a 40% GP loss the next month? And he was adamant that I was right. I'm like, well, how do you sort of transpose this to financial reporting and going, is it nice and linear? Is it looking something like this? So this isn't his data. It's a different client, but it was the same sort of story, right? And he was actually posting the WIP backwards, because the WIP calculation itself isn't actually that difficult. It's when you post it and you go, can I tell a commercial story here and go, yep, these jobs are on track, this one's not. this next job starting, like you should be able to tell a story behind it and the numbers should really sing to you. That's when you know you've nailed it, as opposed to focusing on the calculation. Did I get the right percentage in? Once it's in, it should really sing to you. And you should be able to link the operational performance on site to all the financials and go, yeah, this is making commercial sense. So in this example here, this is literally just month by month by month. And this is a business, well, actually live data, we just de-identified about a couple of years ago of someone not doing WIP. And as you can see here, in July 2022, 200K loss and a 200K profit. And right before Easter, builders love to shove out their invoices before that bloody Easter break, and particularly around Christmas. So you can see in December, 445 grand profit. Rush it out. January and February is obviously a bit of a bloodbath, but it bounces around like a yo-yo. So, for example, if I'm talking to a business, I'm like, well, I know you're sort of turning 3 or 4 million or 5 million. I know you didn't make $1 million profit. That's crazy. Doesn't make sense. If you did, how do I become an investor? Because that's obviously a game changer if you have. So what I'm trying to say here is WIP bounces around like a yo-yo. I don't have confidence that the business is okay. What we want to see is boring and predictable and fold in WIP, and we know it's coming at us, and we know we've got the right number of jobs, the right number of starts, and the right amount of throughput through our business that we actually generate profit after overheads. So ideally, the director and I guess the owners take a wage, and then obviously they get a clip of the ticket, which is this net profit position here. So I've obviously folded WIP in, and then this is the owner's take home afterwards. So this is where you want your WIP to look like. Oh, sorry, this is how you want your business reporting to look like. This is if you don't do WIP, and I can promise you it'll bounce around like that as well.
And I think that the unfortunate thing is, Dan, the bigger you get, the more projects you take on, and the sequencing of those projects, they're all going to be at different stages in terms of when claims going out and cash coming in and, costs being incurred. So this roller coaster becomes even less predictable if we don't land that WIP figure to properly recognize the value of what's happening across each of those projects. It's sort of this real fundamental disconnect from a cash or an invoicing position to, what's actually occurred on site from a cost and cost completion perspective. So rather than, running our success metric off cash in the bank, it's more about our profit position and then using WIP to recognize really where we're up to in all those projects. And yes, we need to be careful about, banks not paying on time or problem clients or, not capturing all of the costs that we expected, in the estimate. Those things are all really important, of course, but having this as a baseline in terms of how we're reporting our profit position, it just gets bigger as a problem as you take more projects on. So regardless of where you're at in the journey, it's really important. But if you're just starting out and you're starting to take on multiple projects, it's really important that you get into this discipline now.
So the theory is all good, but how do we build up a good WIP calculator? To be honest, I could probably teach my mum how to input data into the WIP calculator. It's all the...
That's not fair, Dan. Your mum's a bookkeeper, so...
touche.
Maybe my mum's a seamstress, so maybe you could teach my mum.
Yeah. I mean, anyone can input some numbers into a spreadsheet, but I can't stress how important all the upstream disciplines are. So when I say upstream, I mean, pre-contract, obviously estimating is right, convert to a budget that has all your letting packages in there, raise POs. And what I'm speaking up to is that your bookkeeping discipline has to be absolutely A+ for your WIP data to make sense. If you aren't, so business owners, project managers, construction managers, if you aren't interested in the bookkeeping side or the finance manager side of things and getting the right data against the right projects, against the right letting package, whatever it happens to be, your WIP calculation will absolutely be a nightmare. And I've seen plenty of them. So please absolutely take interest in bookkeeping and making sure that you understand cost of goods sold or direct costs, the difference between overheads, a few other bits. We've done separate webinars on that, so go check it out. But yeah, just make sure your bookkeeping is rock solid. And the way you're doing your job budgets matches how your actuals are coming in. And you get that nice alignment. Make sure there's nothing strange being allocated to it. Otherwise, you get some false confidence that business is okay. Then you get smack at the end, or it goes the other way, and you're sort of understating and anxiety builds, etc. Job costing, so bookkeeping, obviously getting the right data in the right buckets, but obviously making sure that everything that's sitting up in COGS does get allocated to a job as best you can. So please make sure that that discipline is very high. And then the big push here is that if you're sort of turning above like $1 million, $1.5 million, I'd strongly recommend calculating WIP monthly, especially at 2 or 3 or 4 jobs on the go. I promise you it will lower your anxiety, good, bad, or ugly, and you're replacing that with facts, evidence, data, which is good for everyone, right? And then you can hit it with a rational head and go, what do we do? Are we okay? Stay the course. If not, what do we do? The other final piece around this as well is, as Doug alluded to before, is what I care about the most is unders and overs. So what I mean by that is that you might have like a electrical contracting package that might be worth 30K. You'll sublet it out. They'll do the work on site. And let's say the invoice comes back in at 30K. I just could not care from like an advisor standpoint. It's on track, on budget, couldn't care. If that invoice comes back in from the sub trade at 25 grand, well, high fives and hugs. We've made $5,000 extra, in which case, high five, great job. How do we do more of that? Or say the electrical package comes back in and we budgeted 30, came in at 40. Well, we've just cooked 10 grand of our margin, 10 grand of our cash, which is where I'm alluding to, I guess, in this sort of stage here. So the concept here before I go a level deeper is that if you can measure it, so what I mean by that is if you have a project budget, you have your trade package against it, the invoice comes in, you can then obviously manage the outcome. And if you can manage the outcome, you'll make a truckload of cash is sort of how it works 9 times out of 10.
Dan, just as you launch into this, I think there was a sort of a question a little bit earlier on, but can you just, because we've got the estimate column in here, and this is just a visual on the concept of job costing, or it's often called back costing, but can you just speak to, there's a quote that often will go to the client, and then there's the budget or the estimate that we hold in our project platforms, our estimating and job management platforms, and often they'll be the same, yeah. But sometimes there may not be, and some people want to have some extras in the quote or whatever the case might be. But can you just clarify, what are you talking about when you're saying an estimate when it comes to this back costing project process?
Yeah, good point, Phil. So usually in the construction game, I mean, in a perfect world, you'd have all your selections done. You know what handles you're installing. If you're digging into dirt, you know exactly what's there, no rocks, etc. So your estimate would actually equal your budget. So you go, righto, here's all my takeoffs, here's all my bill of quantities, and I just flick that straight to a job budget. And then I go, right, electrical package, 30 grand, invoice goes out, 30 grand, no problems on the site. There should be no difference in that far right-hand column. Sometimes in the construction game, you have to take your best guess. So either a concrete doesn't get back to you, or there's too much price volatility, or you take it up as a provisional sum, in which case sometimes it becomes an estimate, not an actual job costing budget as well. So when we use that, I guess that column there, so invoice comes in, we allocate it against a job, and then if you're using something like Build Xact or Procore, One to Build, whatever it happens to be, you'd find the item in there as well. So when I say item, I mean either letting package, and everyone does this slightly differently. As long as it's measurable, that's the bit I care about. And we go, hey, we estimated that it was 22 grand, or we've actually known. So we sent out an RFQ, got a quote back from the electrical contractor, and we know it's 22. Estimate, budget are interchangeable here. What I care about the piece after that, did we hit that budget item? Yes or no? It is that clear. So this is the unders and overs we're talking about. Why is it important? I don't want to get to the end of the project and go, hey, this project was $1 million. We're 3 months out from the end of the job and we spent 1.1 on it. And we go, oh my God, I talk to the owner and I go, hey, how much more money do you spend on this bloody thing? Another 300K down. Well, there's your margin, there's your war chest gone, etc. If we can see it coming at us, then we can measure it as we go, we can manage it and obviously make a bit of money if it's managed well. So that end column there, we've taken an estimate on what we think the package is going to be, could be materials, labor, trade. How much did that invoice come on board? And the difference between those two, so in this example here, that 5 grand difference, we've actually cooked 5 grand of our margin. And what I want to see from a really disciplined business that has good controls, and again, this is a process of evolution of revolution. This stuff is really difficult to get right, as easy as the theory sounds. I want to see it by job, by item, and monthly where we're winning and losing. This is our scoreboard, because then it gives you, I guess, warning signs, indicators that either your PMs are being effective, your estimating process is effective, is your labor on site being effective, yes or no? And if it is, high fives and hugs, like I mentioned before. If it's not, well, what do we do? And then that's the hard bit. This bit's fairly straightforward, but don't let me trivialize the effort to get your bookkeeping and data right. It's what you do with it. That's the hard bit. Dan, I cooked $5,000 on this. There's no way I could have avoided it. What do I do? And I jump in and say, rubbish. We're not going to do this every time. What do we do? So this is what proper job costing is.
So bringing it back and why we're focusing on job costing, if we kind of think back to how that WIP calculation works, we need to know for each project how much we've spent or how much cost we've incurred against the project. We're not going to know that if we've got multiple projects running, if we're not allocating costs to the project in our software, or even in a spreadsheet somewhere where we're saying, okay, here's what I've incurred. These are the costs so far in this project. So therefore I'm 30% through, or I'm 10% through in terms of the cost base for that. So that's why, WIP is dependent on a number of upstream processes, but fundamentally it's about making sure you've got bookkeeping data flowing properly and that you've got this discipline around back costing or job costing. We might just, Danny, we might skip over that poll just because I think we've got some nitty gritty stuff to get on with here. So that should hopefully for everyone, sort of, I guess, give you a call to action around, or at least the why and the what WIP is. Now we're going to go into some more detail with Doug. Now, what we're going to show you now, we'll share out a spreadsheet that we use and we've used with clients over the years. These days, we have a software platform that we use called Clarity, which we've built in-house that brings all this data in automatically from, whether you're using Build-A-Trend or Wonderbuild or Build Xact, and then Xero. So it brings all the data in together. And so that's what we're looking at here. And Doug's going to take us through it. But essentially, it's the same calculations. The only difference is that the data is coming in automatically via API in this tool, whereas the spreadsheet that we share out to you, you're going to have to pull that data out of the platforms and drop it into the spreadsheet, which we know is laborious, but it's a discipline that you must get into on that monthly basis. And obviously, you're only going to be able to do it if you're allocating the costs properly to the jobs. But Doug, we might just jump straight in now and go to the job by job level of detail, working left to right, so we can see how this WIP calculator is, how this WIP figure is calculated. So over to you, Doug.
Thanks, Phil. Intro there. So as Dan's been through all the detail there already, super important to make sure this calculation makes sense. You need to have your job costing in place and up to date. Otherwise, this is going to be a futile experience for you. So this is Clarity, the platform that we use to do our WIP with our clients. And what I've gathered here today for you guys to look at is actually some anonymized real client data. So these are actually real examples that we work with one of our clients. Just so all the data is real, we can look at it. You can see that these gains that are possible. And this. So stepping through it now, we have 3 jobs here as an example. On our first job here, we have a contract value. So we got a contract value column here, which is $1 million. We have what we've invoiced against the project so far, which is $894. We have our contract cost, including any variations that have popped up and we've added in over time. And that's sitting at $836,000. So that's our budget. And then we have what costs we've actually incurred to date. So we pull that figure from our financial system, Xero, and it's sitting at $708,000. So if we look at our contract value versus our contract cost, we're estimating, okay, one minus the other, we're going to get a 23% margin on this job. And we're calculating at the moment that it's 85% complete. Because if we look at what the cost is versus the contract cost, we're 85% of the way through from a cost perspective. Now, coming right over to the right-hand side here, we get to the WIP figure of 155K. Now I'm going to step through, how did we get 155K positive WIP on this job? So what's happened here is this particular builder has actually made trade gains of 101,000 against this job. Now, from memory, this was through the driveway. You save about 20, 30K. It's a nice big long driveway on the driveway estimate. And then he also has a lot of contract admin put in his budget and his contract management, so supervisory work. So he's hitting a lot of margin in his estimate there, which is really good to see. So we come to 101K of savings. What that means is he's actually sitting at a 32% gross profit and he's actually 96% complete. Now, how do we get that? So if we look at the contract cost, it was 836, but we saved 101,000. So round figures here, we're now down at 736,000 for our contract cost. And if we compare that to how much we spent, 708, well, that's a lot closer. We're now 96% complete because we only got about 25, 30K left to spend. Then we get our earned revenue versus what we've actually invoiced. So as we went through before, he's invoiced 894K. But if we look at how much he's earned on that job because of the money he's spent, swinging the hammer, building it, doing the work, he's actually sitting at 96%. So what we do is we go, okay, let's grab 96% of the total contract value. Therefore, he should have invoiced 1.05 million so far. And that's how we get our positive WIP of 155K, which is the difference between the 894 and the 1.05 million here. So that is a underbilled situation. Now we've got two other jobs here, and I won't step all through them. The calculation works exactly the same. We've got a job here where there's no overs and underspends, but he's overbilled on it. And another job here where he's actually overbilled as well. So then we get our total overbilled amount, which is 270, our underbilled amount of 155, which gives us a net WIP position of 115K. Now, for those out there that are more visual and can make sense of this visually a lot better, like myself, staring at grids and numbers is a lot harder. I like to just see a pretty picture of where am I at. So down at the bottom left-hand corner here, it's the exact same, but more a visual representation of it. We can see here on the first job, the top bar there in the green area is the cost. So we've incurred 708,000 of costs so far. And then we have the blue bar below with the green portion. So the blue bar represents what is invoiced, and then the green portion represents the positive WIP. So we can see out of 100%, we're nearly all the way to the end on our billing. And from a cost perspective, there's still a little bit more to go there. The gap between the end and the cost there is just the savings that is made on that job as well. So that's a really quick step through there, Phil, because I know we're tight on time, on how the WIP calculator works. So as you said before, we pull this data in automatically through APIs for our clients. However, the spreadsheet you guys will get has the exact same functionality here. You can put all those figures in manually, pull your data in from your building system, pull your data in from Xero. And it's really important that you actually use your cost information from Xero or your financial system, whatever it be, because it can be the circumstance sometimes where not all your costs are sitting in your building system. Some of them can get missed, and we can see it with our clients as well. Data isn't perfect, and if you use the building system costs, you can find, even though you do your WIP based off the building system's cost, that it's going to be wrong at the end of the day as well. So you need to use your financial system, which is your sole source of truth, because every dollar in your business flows through that. Like your building system, not everything can get captured in there sometimes.
Yeah, which is predicated on the idea that almost always your invoices are going to be flying through your accounting software. That's where your BAS has to be calculated, tax flows out of that from a compliance perspective. And if you've got a bookkeeper or if it's you yourself, oftentimes it's going to hit zero. But it just depends on your discipline in terms of bringing that cost over into your project management software. And that's a full spectrum. We recognize, and we've got clients who have really good processes in place. Obviously, the ones using our bookkeeping service as well, but really good process in place to make sure that Wonder Build or Build Xact or Build a Trend matches zero. And we've got all the tracking categories and codes set up, and the process, not just the codes, but the process to allocate the costs properly so that those systems reconcile. I guess, though, what Doug's saying there is that ultimately, depending on the level of hygiene, we would always take our accounting software as a source of truth because we know that all those invoices ultimately are going to have to pass through Xero. So, Doug, just at a there was a question a little bit earlier on around end of month. When do I do this figure? When do I have the pie has been baked, and I know now that I can calculate this number with certainty, because we're relying on external factors often, aren't we, in terms of when we're receiving invoices and the like. So in terms of your recommendations of when we are going to crystallize this WIP figure, what's your recommendation there around that process?
Yeah, so in the big business world, as Dan explained before, you're going to have an end-of-month process and you're going to have cut-off periods.
Yeah.
Scale businesses with lots of systems and process, automation and resources, they're going to do a cut-off at the third day of the month. However, small business, a little bit more messy, things flying around. What I'd recommend is by the 5th business day of the month, at a minimum, that you cut it off. And what I mean by that is, if you have invoices still coming in on the 15th of the month, the 20th of the month, and you're waiting for every single invoice to come through for the work that you did in the previous month, you're never going to find that you're going to be able to cut a WIP figure. You're always going to be chasing your tail. You're always going to be changing and revising it. So I recommend to pick around that 5th business day. It's going to be different for every business. It might be a little bit longer. It might be a little bit shorter, but have that cutoff where you say, no, I'm closing my books. No more costs going to the prior month. And we're setting our figures at this point in time. Now, you might think, oh, well, I've done that work there, but I haven't put the invoice in. So won't my figures be wrong? Well, so that's where WIP comes into it. That's going to capture that work that's been done versus the invoice coming in. That's going to close the gap. And that's what WIP does. It closes that lumpy gap of you trying to wait for those invoices all to come in. So it doesn't really matter where you cut it off. I'd probably just pick a more sensible time for your business. You've got all your payroll done, all the wages have been put in the right place. Majority of the invoices that have come through, cut it off, cut your WIP figure. It'll capture the difference and you move on. But it's very important that we cut it off at the same time every single month as well. So then you get that consistency and you can tell your bookkeeper or your accounts person that's doing the accounts, on the 5th of the month, we're going to cut it off. No more costs going into the prior period. Anything that comes through, we're going to put in the current month and we'll capture it next month. WIP will make the difference.
Indeed. And yes, there's a question there around, being able to see things like super and, other entitlements and the like in Xero versus seeing that in Build Xact or project management software. This is where your journal entries are going to have to come in as part of the end of month close to make sure that you're properly allocating all of those additional costs into the accounting software as well. So there's a sort of an end of month checklist, and that's a whole other webinar of things that you need to do as part of that disciplined end of month close. But it's very important that your accounting software is able to account for all of that activity as well in the right place. Okay, that's the ins and outs of how we calculate WIP from at a job level and across the business. The spreadsheet that we send out will also have some instructions around where to pull this data from, in terms of whether it's from Xero or your project management software as well. So there's some other instructions that come along with the tool. As we said before, though, Clarity just brings all that data in for you automatically. So it's a really handy tool from that perspective. All right, thanks, Dougie. Great explanation there. Dan, we might just come back to you now, if that's okay, just to close out this last bit around. Okay, that's all well and good, and I can see Doug's example here, net position of negative WIP 115. It might be a positive WIP figure of 350,000 or whatever the case might be. So what? What does that mean in terms of decision making in the business now that I have these regular monthly figures in front of me? What can I do with that information?
Bill and Doug, nice presentation. I guess the WIP calculation itself is an unlock to, give you more information on your business and help business decisions for the future. So as far as your stack of building a successful business, you have good bookkeeping processes, good people in the right roles. You do the end of month close, whether it's yourself or you outsource it or you internalize, it doesn't really matter. But what you want to do is go, well, measure yourself against a budget. Are we profitable? And then do we hold the course? So if we're sitting down doing a business review meeting, because we don't just want to do WIP and then charge on and then not review it, we want to produce good reporting, sit down and go, well, what does all this stuff mean? Is it good? Is it bad? If it's good, how do we do more of it? And then if it's bad or if we're off track, well, what do we do? What's the call to action? So if we aren't doing WIP and finance the numbers, it will bounce around like a yo-yo. And then how do you make decisions on your business? 1 month's a huge loss. 1 month's a huge profit. Like, how do you get off that emotional roller coaster and that cash roller coaster and go, remove all the cash whirlwind? I understand cash is super important, but how do we ensure the business is profitable enough in the pipe and the go forward is strong? Like, that's what I want to know. So the learnings is, well, don't fly blind. I know WIP can sometimes seem like a bit of voodoo and it's an acronym and people can shy away from it, but I just can't stress how important it is to really decipher and understand your numbers. If you're lucky enough to be, I guess, a senior leader in a business or own your own business, like, don't do the clench and hope strategy and go, I got enough cash. Understand your WIP, understand your profit, and you'll be able to plan your way out of most things. The other big bit is understanding whether your WIP's positive or negative. If it's negative, be really careful of looking at that cash at bank and go, yeah, I'm going to buy myself around. Or if you have low cash, like, don't freak out if you're carrying a huge positive WIP position, which means you've spent more than you've invoiced out. Hold your composure. It'll be okay most of the time, obviously, but understand your numbers, funding, et cetera, et cetera. And the big bit is as well, what do these numbers mean? What does the forecast look like, the future look like? And then you can plan for your business's future around it. What is the call to action? What do these numbers say to me? How is it singing to me? That's what we want to do when we bring all this reporting together. And then probably the last slide for me, the final piece is you have to figure out, well, who's going to do your WIP? Who's going to do your end of month close? Who's going to do your reporting? And who's going to tell you everything's okay? And there's a couple of paths here. Path one is the DIY process, which a lot of people do. It's okay. But at some point, I'd probably recommend tagging in an expert. So option one is you do it yourself. You watch this video 3 or 4 times, you watch a couple other videos 3 or 4 times, have a crack at it, drop it in and go, oh yeah, close enough is good enough.
I guess if you're starting out, Dan, that's probably your only option, right? Like, it's,
yeah, correct.
You're wearing all the hats, you're doing all the things, and even though it means long hours, having the financial clarity is better than not. So, and hopefully, it's still at the point where you've only got a couple of projects underway, so it's not as complex as, when you're up to 5, 6, 10 projects.
Yeah, and depending on where the appetite goes for your business, I mean, there'll come a point where you go, right, or conversations I have with my clients or potential clients are, hey, how long did it take you to do that WIP? Oh, it took me about 6 or 7 hours. I'd rather you spend those 6 or 7 hours chasing the next lead, closing the next deal, finding talent, like stick to your lane of what you do best and what got you here in the first place. So if you're tired of the DIY, which I'm sure a lot of people would be, well, you might be able to train your bookkeeper. So good data, good hygiene. Hopefully the data pours into the WIP calculator. Maybe watch this video a couple of times, pull it into your Xero reporting, Mob, whatever it is, and then go, does it make sense, yes or no? The other option is you find someone that looks like Doug or me, hopefully a bit better looking than me. They can come on board, a bit smarter than me as well, and they go, right, this is how it looks. And if you're lucky enough to find someone like that, obviously grab hold of them. Obviously, if you're at the right size and the right stage and profit and all the rest of it, that can obviously be a big boon.
It's almost the opposite, isn't it, Dan? And this is like, now I'm not a small business. I'm actually, I'm building out, and this is sort of I guess we're sort of talking 30 to 50 mil turnover. I can have, I'm gradiating on from having a bookkeeper who's just doing sort of transactional stuff, that I've now got like a head of accounts or a commercial accountant that's overseeing my accounting function. So we're probably, I don't know, circa 500K in on a accounting team at that point. So that doesn't really make sense until you're starting to get to that sort of 30 to 50 mil turnover.
Yeah, correct. I mean, because someone that looks like Doug or I, and again, this isn't a tax person, this is a commercial person. There'll be a very good one. Will be a very, very, very decent 6-figure package. So something to be aware of. So clench for that when that comes. Or the other option, depending on how big you want to get, or whether you want to sort of get to 5 mil, 10 mil, 20 mil, whatever it is, you can think of a fractional service, or I guess like an outsourced service like us, or it can be someone that looks like us, but someone that can really get into it, understand it, put it together, shape processes, shape systems to give you good data for decision making. to let you know whether you're okay or not, which is a service we offer.
Yeah, and that fractional thing means that you're getting someone like a Dan or a Doug, but they've got a portfolio of clients. They'll have 10 clients or so that they're looking after. So you're only paying a fraction of their wage as opposed to having to put a full-time 6-figure commercial accountant on to do all that work for you that is starting to stretch you from a technical perspective, like the real nuts and bolts of how this commercial accounting stuff works, but also just the time. Whether you really want your bookkeeper or yourself to be working on this sort of stuff when there's higher leverage activity you could be getting on with. Okay, I wanted to just mention quickly before we wrap, there's a lot going on, and I know that down the pub or the club or wherever you hang out, there's a lot of talk going on Current Affair or the Today Show about what's happening with tax reform. We're running a webinar later this month to give you an update. So some of this stuff has started to pass. The legislation around family trusts and discretionary trusts is still at consultation stage. So we're going to run a webinar to give you an update on where things are landing right now. It is material. These are changes that we haven't seen for generations, really. So it's very important that we all are up to speed with how this is going to affect your business and particularly, your tax position, and that we get the right information rather than just the, hearsay along the grapevine about what might or might not be happening. So we'll be sending information out about that. Very quickly as well, we're running these strategic planning workshop series. This is a 3-month series that we run. It's a day, a month, over 3 months, where over the 3 months, Dan and the team will build your own specific strategic plan to see you through the next 10 years, back then to 3 years, 1 year, and then you'll leave with a very clear picture of where you're headed and all the inputs and ingredients you're going to have to get right to succeed on that plan. So that is happening. We'll send you some information out about that. I wanted to just quickly launch this poll. If you are interested in any of the services we've talked about today, please let us know. I've just popped that poll up there now. So the first one is, as I was just sort of talking about, the tax reform piece. How do I structure my business? Am I trading in a trust? Am I trading in a PTY or D? Do I have a bucket company? Do I set up a special purpose vehicle for the property developments I'm trying to run? What if I'm going into JVs with other people? All that sort of stuff is important to get right. If you want to outsource your bookkeeping to industry specialists, that's that option there for you. If you want to engage a financial controller on a fractional basis, so Dan mentioned that business model earlier on in terms of how you might calculate your WIP figure, but really the whole end of month package. So my financial reports all tied up with a nice bow for me every month, and then someone like Doug and Dan to sit with you to unpack that, learn what it means. Very importantly, though, that service is about looking into the future. So we spend a lot of time forecasting with clients in the FC side of the business. And then finally, if you want to grow your business and have an experienced advisor to either help grow the top line, I really want to scale the business, or I'm quite happy turning over 10 to 15, 20 mil, but where is my profit? Like, how come I'm not seeing the margin that I'd like to see? That service, ScaleX, is all about having a partner to help you on that mission and do it safely and with your eyes wide open with confidence around your decision making. So I'll just leave that up there while I say, again, we'll be sending out that calculator. That's going to go out to everyone. There'll be instructions in the calculator along with the video to help you walk through how to use it. We have our tax webinar coming up, so please join us for that if you want to find out what's going on in that part of the world. And finally, that strategic planning workshop, if you'd like to join us for that. It's a really small room, only 10 people for each cohort, and we've had amazing, actually, it's really nice doing that series. The sort of impact that we can have is very rewarding for everyone. Okay, Dan, thank you very much, mate. As always, the way you describe this stuff and the experience you've had, working with hundreds and hundreds of builders that you've had over the years is really great for us to learn from. Doug, thank you for getting into the detail today and running us through how WIP is calculated at an accounting level. Thanks for that and for showing us clarity as well. That was awesome. Cheers, Dougie. And yes, thank you everyone for joining us. We will see you next time. All the best out there. Stay safe. And we wish you all the best for the coming month. See you later.
Peace, everyone. Bye.